All right, and we should be live now. Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another monthly live Ask Anything Q&A with our stable of endorsed financial advisors. Let me pull the guys up here. As usual, we've got Lance Roberts from RIA, and we've got John Lodra and Mike Preston from New Harbor. Hey guys, how are you?
Hello, Adam. Hello, Lance.
Hey, how are y'all?
Hello, everybody.
All right, happy Halloween, guys. Got a lot of questions from folks, but we got to start with a really important one, which was, Lance, was this actually you last night?
That was me pregame, right? So my wife took that photo while I was getting ready for Halloween last night. Yeah.
God, I saw you put that on Twitter last night and just felt completely underprepared for my Halloween game. You set a high bar, sir.
That's all right. Wait till next year. I got a better one. So
okay, you've already got it planned. All right, everybody, a couple quick housekeeping points before we dive in here. First off, introduce yourself in the live chat there, if you will. We'd love to see who's watching us. Let us know where you're watching from. Also, use that same live chat to ask your questions here during the live recording of this. If you're not watching live or you can't watch the whole hour ahead here, don't worry. Because this will turn into a replay video as soon as we're done with it on YouTube at the same URL. And if you're watching the recording, hey, everybody. All right, so let's jump right in here. Lots of questions this week about rates and treasury yields and whatnot. Before we jump in, real quick, let me just kind of ask you guys to sort of level set. It's been a month since we've done one of these live Q&As. What's your current assessment of just where things are in the markets right now? Lance, why don't we start with you, then we'll go to the New Harbor guys.
Well, so, really about 5 weeks ago, we were talking about that the market had gotten very oversold, extreme negative sentiment. We were due for a fairly decent rally in the markets. And we talked about using this rally to, basically, use it to reduce risk and rebalance portfolios and do those type of things. And so for the last 4 weeks, it doesn't seem like it. If you actually just think about how people feel about the market right now, it doesn't seem like October just turned in the best performance for the Dow since 1975. But that's what happened, right? And so if you take a look, markets have been coming up here. We're on a buy signal currently. Equities are performing okay, particularly outside of the kind of the big FANG stocks. A lot of the markets doing exceptionally well. So again, nothing really overly concerning at this point. What importantly happened back in mid-October is that we held those the June lows of the markets. We had broken down below that with the CPI report, immediately recovered back above that, and have been rallying ever since. So holding those June low supports were very important for the markets. And now going into the end of the year, we've got a couple things going on. So in October, you had 25% of mutual funds had their year-end fiscal year ends. And so they had to rebalance portfolios, do distributions, capital gains, those type of things. So that led to a lot of that additional selling pressure in the markets. You also had a blackout of corporate buyouts we talked about last time. So now in the month of November, you only have 5% of mutual funds have year ends. And then in December, you've got 20%. So this is why in the first 2 weeks of December, you typically get a little bit of volatility in the market and typically a sell-off as those 20% of mutual funds do their distributions and interest income distributions, et cetera. And then you get your Santa Claus rally because they all have to reposition for the end of the year to have their books balanced for reporting for the end of fourth quarter. So, market's doing kind of exactly what you'd expect them to do. Going into November, we've got two important events, three actually, coming up in the next 2 weeks. We've got the Fed tomorrow. We've got the midterm elections on Tuesday. And then this coming Friday, we have the employment report. So, all that could definitely provide to some volatility in the markets. After that, it gets fairly light through the end of the month. And with buybacks now, coming back on in force, and we talked about last week, that roughly equates to about $5 billion a day in additional net buying to equities. There's a potential for this market to kind of drift higher over the next couple of weeks.
All right, John, why don't we go to you for New Harbor, and then Mike will let you chime in.
Whole session doesn't sound like we're all agreeing on the same things, because we very much are in agreement with what Lance just said. But we think the data, and I'm sure Lance research points to this. We did get a very oversold level handful of weeks back, we did use that opportunity to add some hedge tactical long exposure, not because we felt like the ultimate bottom was likely in, but we saw increasing evidence of the likelihood for a short-term bounce, and so far that's exactly what we've gotten. And nothing about this is about precision or perfect. In fact, our use of hedges is an admission that we can't time these turning points perfectly, but rather we want to try to, in a risk-adjusted, appropriate way, harvest some modest upside during these bounces and use that to lighten as well. And in fact, just today, we're going to be taking off a piece of equity exposure that we added a few weeks ago for most of the objective gain that we were looking to get out of that trade. So very, very much an environment where we think it's important to be nimble and tactical. And yeah, we can't say that today was the top. Very, very possible, maybe even likely that we get some follow through for the next several weeks. But the backdrop is still very supportive of likely further pressures to the downside. There's pent up hope for a Fed pivot, if you will, as to being the permissive move for risk assets to fly to the moon again. We don't see that being a slam dunk by any stretch. Just today, for example, job openings numbers came out more favorable than the market was anticipating, and that's not a helpful thing to the Fed looking to become more hawkish. But I'll just pause there and see if Mike has much to add there.
All right, Mike, you want to add anything?
Just a little bit. I mean, it's been a really vicious rally off of a technical support zone the last 2.5 weeks or so. Yet again, the market has this fast and furious rally. We're up about 12% on the S&P in under 3 weeks. So it's very similar to what we saw in June through August or so. And, we think it's yet another rally that's likely to fail. But it doesn't mean we're not doing anything. We did put a long position off. We're taking it off as we speak because we got a 90% profit of our target on it. And so that's what we'll keep doing is continue to be tactical. But overall, we see lower lows and lower highs so far. So it's still a bear market to us.
Okay. So you guys talked about some of the important things that are happening this month. Obviously, the election is the biggest one. I know we don't really do politics on this channel, but generally the market tends to favor a gridlocked Congress. So let me put it this way: if the elections go as I think the current polls show that at least Congress will be divided, and there's a chance that it could fully go over to the Republicans, both sides. But let's just assume it's divided. Is that going to be market positive, do you guys think? Will the market react favorably because it thinks less will get done and therefore it has more confidence in what's going to happen? John, let's go to you real quick. And then Lance, I'm sure you got an opinion. I can see your little smirk there.
So I guess one of the most important things that Mike, Lance, and I can do in our seats is to be humble and blurt out when we don't have an answer. And this is one I'll say I have no clue. I honestly don't. Divided or not, I think there's so much dysfunction in Washington that it's maybe even a kind of a circus question to even kind of try to answer. I honestly don't know. All I know is we can look at the backdrop of the economic and market environment, and I would say that notwithstanding any short-term knee jerks of market watchers reading in something to an election outcome, I can honestly say the bigger picture probably trumps any kind of result in Congress in the midterm elections. That's about all I have. I'm not an expert in forecasting that dynamic by any stretch.
All right, Lance, thoughts?
Yeah, so I've actually got an article already written and teed up, and it'll publish next week after the election. So it's basically talking about midterm elections, what happens. So, look, all we can do is go back and look at market statistically. So first of all, it doesn't matter whether Republicans win the House and or the Senate. It's gridlock either way because you have a Democratic president. So, unless they can pass things with, more than 2/3 of the vote, right, to pass vetoes from the president, nothing's going to happen. So you've got gridlock regardless of how this is going to work out. Historically speaking, whenever you have a gridlock Congress, markets tend to do better. And in fact, after 100% of every midterm election going back to 1938, the markets have performed positively over the next 12 months. So take that with a grain of salt. Doesn't matter whether it's a recession, bear market, bull market, secular bull, secular bear, hasn't mattered. Every midterm election, stocks have performed positively over the next 12 months. Now, here's the caveat to this. The average return over the next 12 months is 18.6% after the midterm election. That sounds great, right? Well, the problem is if you get an 18.6% rate of return, you're not back to even to where we were in January of this year. So you've always got to take these statistics with a grain of salt, because getting back to even is not the same thing as making money. In order to get back to even from where we were at just when I wrote this article week before last, we were at 3,800. I said, so to get back to even, you need a 26% rate of return to get back to even. So for that, the midterm election then says, well, post-midterm elections, the next 2 years, stocks return on average 33%. Now, over the next 24 months, we should be well out of whatever bear market cycle we're in and, be working our way back on the upside in the next bull cycle. So great, 33% return. That gets you your 26% you need to get back to even from January of this year. But hold on, because again, statistically speaking, that sounds great, except you've also lost the 2 years of 6% rates of return that you need just to get to your financial goals. And this is the one thing nobody ever talks about in the media is, when you have a big drawdown in your portfolio, getting back to even certainly feels like an accomplishment, but you always forget about the rate of return you needed to reach your financial goal to start with, which is now compounded on top of that. So, 33% returns over the next 24 months is still going to leave you about 20% short of where you need to be to reach your goals. So, there's a lot of things to think about, but from the midterm election standpoint, stocks tend to perform better in a grid turn. And this is just what statistics say. I'm not making a definition of absolutely this is what's going to happen. Just telling you what statistics say. Markets tend to perform better when they don't have to worry about a bunch of crazy tax bills or, going after to tax the rich or imposing a windfall profits tax on oil companies, which was the latest conversation yesterday. If Wall Street can kind of focus on what is and what is the case, and without having to worry about these extraneous issues coming in, stocks have a little bit better runway at that standpoint. Because look, we've already priced in a lot of earnings decline. Yes, we have more to go. Absolutely agree with the other comments a second ago. Next year we're going to have an earnings recession. We're going to have an economic recession next year. There's virtually no way to pass that. Unless the Fed immediately starts reversing policy, lowering interest rates, going back to QE. Can't see them doing that right now just because of their focus on inflation, but that's what it would take. And so X that, you're going to have a recession next year. Higher interest rates are going to lead to slower economic growth. So stock prices have more to decline, and they've got more to work through before we get valuations aligned in a manner where we can actually start the next bull cycle sometime next year.
Okay, yeah, and that's just a good thing to point out, which is I think the bias of all you guys, and correct me if I'm wrong, but the bias of all you is similar to what Lance just said, where you look at the fundamental picture and you say, look, it's hard not to see, or it's pretty easy to make a case for lower prices ahead, or it's easier to make a case for lower prices ahead than it is for higher prices. At the same time, we do have certain catalysts in the system. One is if we do get a gridlock Congress, as Lance just said, the data shows the next year tends to be pretty good. Second is at some point in here, it's probably pretty likely in the next 12 months that we will have a Fed shift of policy. And I'm not specifically saying pivot because they might just pause, right? In fact, I think that's the guidance the Fed has been giving, which is when we stop, we don't plan to go down right away. We plan to hang out for a while and see what's going to happen as all the rate hikes that we've done in the past kind of catch up. So the point here is we've got to always have an eye on what could happen, even if it's not what we think what should happen here. All right, so I'm going to come to you now, Mike, with this next question that's been asked by many. I think Larry does a pretty good job here of capturing most folks' sentiment, which is, why does anyone think the Fed is about to pivot? He says you're all going to feel pain. We haven't felt the pain yet. Lance just mentioned the recession might be coming. We still have a lot of denial that we're actually in one by lots of sources. So the Fed is going to make an announcement pretty soon. Do you expect a policy shift yet? And B, if not, to Larry's question here, how much further rate hikes do you think we have ahead of us before the Fed at least pauses?
Well, I can say that I'm not an expert Fed watcher, but it is all about the Fed and has been all about the Fed for many years. I would say that that's the elephant in the room that we talk about 90% of the time. The Fed really seems very serious about fighting inflation. We just went from a period of almost no inflation to 9.6%, and of course, that caused this big flood into I bonds that everybody is asking about and talking about in the last few months. Inflation has erupted post-COVID. Nearly $7 trillion in printed money, either through monetary or fiscal stimulus, just handed out to people, and and a lot of that time for a whole year, people really couldn't go outside and do anything. So, they spent the money, they spent it online, they spent it on Amazon type things, and it's caused inflation. It's led the genie out of the bottle. I have to think that there's massive pressure on Jay Powell to tame inflation, particularly as we head into the election, which I guess is only next week at this point. Time's flying. So, everyone talks about the pivot. It's almost the only thing that people talk about. And we're just not sure. I'm not sure that they are going to pivot. We've got a rate decision, I guess, tomorrow. It's probably going to be 75 basis points hike, 0.75%. That's already baked into the market. Seems like the bond market has overreacted, in my opinion, particularly the long end of the market. So, look, I don't think they're going to pivot. I don't think they're going to go right back to quantitative easing. I think eventually they will. But I think that people are fooling themselves if they think the line in the sand or the Fed put is here at just a very tame 20% or so decline in the S&P 500 off of the most overvalued market we've ever seen in U.S. history by far, and what still remains an extremely overvalued market. We're not even back to the very top of prior bubbles. For instance, the tech bubble peak in March of 2000. Looking at valuations, we're not even back there. We're maybe right around there. So to think that the Fed is going to pivot here is probably a misplaced hope. Frankly, we try to make our decisions based on fundamentals and on data, and we're not going to take any much larger aggressive positions until we see much better valuations. And for better valuations to happen, we're going to need either lower prices or rapidly expanding profits, rapidly expanding GDP, which we don't see. Almost all of what we've seen in this wealth effect these last 10 years, it's a bit of a crime, but it's been an illusion. It's printed money. It's if we don't have the growth to bail it out, we're going to find out just what the price is, and we're going to see the bottom fall out of markets. Probably, I think that that line is much lower than here. So to be investing and trying to front run the Fed and thinking we're going to get a huge rally back to new highs based on a Fed pivot is very dangerous. I can't say that it wouldn't happen because anything's possible in this market, but I would expect the Fed not to pivot anytime soon, and certainly not until we see much lower stock prices. We have to have a lot more pain first, I think, before we see that.
Okay, so Lance, I'm going to come to you. So folks, I'm combining lots of questions that folks are asking here, trying to keep them condensed here. But a lot of people asking, okay, so if rates are going to go higher, at what rate do you think they might peak? And really, like, when should one lock in the rate and at what duration? So Lance, we'll come to you for this. What's your strategy right now as rates are continuing to creep up, in these treasuries? How do you plan to take advantage of them?
Well, first of all, rates aren't creeping up in 10-year treasuries. They've been stuck at roughly a little bit over 4% now for the last couple of months. So despite the fact hiking rates, 10-year treasuries have pretty much peaked here, and that's what you'd expect to happen anyway. Look, the Fed's going to try to hike rates 75 basis points tomorrow, 50 points in December, then 25 basis points in the first two meetings of next year. There's a real risk they won't get to those latter rate hikes. The reason is the Treasury, and I've just published an article on our website last week called the Treasury market's the next Fed crisis. And the problem is the Treasury has to issue debt. And without that artificial buyer of the Fed, nobody wants to buy the debt. This is why rates have been creeping up. So eventually, the problem really for the Treasury is twofold that's coming up. In February, they're going to hit a debt ceiling, and they're already running above that rate. So, you're going to have a whole nother debt ceiling problem coming up, and the Treasury is going to have to find a way to issue more debt and not have interest rates go up sharply. Because again, already, if you take a look at the tax revenue that comes in from taxpayers, it takes more than 100% of tax revenue to cover just basically mandatory spending, which is Social Security, Medicare, Medicaid, Affordable Care Act, prescription drug benefit, and interest on the debt, which is now at the high. The amount of interest we're paying on the debt has been skyrocketing here. So more and more of tax revenue is getting absorbed by higher interest rates on the debt we've already got issued, and we need to keep issuing more, and that's the problem, just to make ends meet. Because again, everything in that non-mandatory portion of the budget, defense, education, climate change, whatever you want in that non-mandatory spending bucket, all has to be done with new debt. So the big problem for the Fed continuing to hike rates is that they're going to wind up in a real front-end battle with the Treasury sooner than later. And again, while they probably won't, and I agree with Mike, they probably are not going to go back to QE anytime soon, but you can probably expect to start seeing something like an Operation Twist, where they'll continue to sell off the front end of the curve, but start buying the long end of the curve, which is going to try to help slow that rate down, but also give the Treasury an area that they can sell those Treasury bonds into. So again, we talked about before, and one thing we're looking at doing right now is extending the duration in our bond portfolio even further. We're currently got about 9-10% of our portfolio in 20-year durations. So now we're talking about moving half of that into 30-year durations to pick up some extra exposure in terms of duration. So as rates do start to buckle and come down, as you get into a recession, as you get disinflation, if you take a look at money supply tells you everything you need to know about inflation right now, where it's going to be in the course of the next year. You want to be on the longer end of the curve, because that's where you get the most bang for your buck as rates start to come back down.
All right, and can you just explain a little bit that bang for the buck? So right now, Treasury bonds, and correct me if anything I say is wrong here, but right now, long-term Treasury bonds are kind of interesting because they pay you something now where they didn't pay you much before, right? So they're paying for something. So you get paid to be in them. But then you sort of have this option value that you're talking about here, where if rates start coming down, the price of today's Treasury bonds should appreciate. So just kind of guesstimating here, Lance, if the Treasury interest rate, the 30-year Treasury yield goes back to say 2, what would that mean in appreciation terms if you were to own a 30-year Treasury that you bought today?
Well, let's
use
the 10-year Treasury, because that's what people focus on the most.
Sure.
People are a lot more familiar with the TLT, which is actually a 20-year duration. But let's say you buy TLT, which is a 20-year duration right now. If rates go back so when we have a recession next year, yields are going to fall below 1%. That's just a function of math. When that occurs, you're going to have about a 60% appreciation in TLT price-wise.
Okay.
That's the math.
Okay. John, let me come to you because I know you guys have also been looking at long bonds. There's a question here which says, so what are the pros and cons of buying a Treasury bond versus investing directly in a fund like TLT, which Lance just mentioned?
Yeah, happy to answer that. And I'll just pick up on something Lance just talked about. The calculations of the return. Well, so for example, we know if you buy a bond today, an individual issue bond, we know exactly what your yield to maturity will be if you hold it to maturity. Now, the value of that bond can certainly fluctuate over time between now and maturity. And depending on what happens to interest rates, the bond will either go up or down in value. So yes, it's absolutely possible to lose money on a bond if you sell it prior to maturity, if interest rates have risen relative to when you bought the bond. And as much as we want to talk about the upside in bond, which we do think there is one. In fact, I'm going to try to share a chart here in a second here. And in fact, let me do this. I'm going to zoom my email up here. I'll try to talk while I do it. But came across a chart yesterday that's put together. It was great. It just showed the sell-off in bonds, 10-year Treasury bonds, going back to like the late 1700s. This year so far has been the worst year since the late 1700s. And the chart interestingly showed that the year after that prior sell-off was up almost 100% on the 10-year bond in the following year. Now, unfortunately, or fortunately, I guess, if you understand how to do math, that's a mathematical impossibility for the 10-year Treasury bond to have such high return because of where yields are right now. And I got to give John Hussman kudos. He quickly caught that that insinuation, and in a tweet reply to that chart said, hey, there very well may be some great upside in bonds here as a counter trend at the very least. But even if the 10-year Treasury yield went to zero, the total maximum return on that bond could not be mathematically more than 49%, something like that. So and Lance talked about this, or at least referenced it indirectly. The calculation of yield, maturity, and the gains on bonds are a function of what interest rate moves have occurred and what the duration of that bond is. So it's a very calculable number to get your arms around. Now, in terms of the question of the pros and cons of investing in individual bonds versus funds that hold either mutual funds or ETFs that hold a portfolio of bonds, it's pretty simple. When you own an individual bond, you have the ability as the owner of that bond to hold it to maturity, so that to guarantee that your yield to maturity at least matches that minimum number. When you hold a pooled investment like a mutual fund or an ETF, you don't have control of an investor over the maturation of those bonds, and whether, for example, in an open mutual fund, whether those bonds need to be sold prior to maturity because investors are asking for their money back. And those managers could be forced, for example, in an open-end mutual fund, to sell those bonds at a time where there are losses on the principal, and you don't get to kind of wait for the yield to maturity. So it's not to say that bond funds and bond ETFs can't be perfectly fine, and in fact maybe even good ways to play interest rate moves, because if it's a tactical trade, especially that you're kind of planning on hopefully get some yield on that, but also on a thesis that there's likely to be a bounce in those bonds because interest rates have gotten overdone to the high side or whatnot. And exactly, Lance talked about we don't necessarily need to have a Fed pivot, which I agree. I don't think it's imminently likely. They're not going to give up that option to if they pivot now, they've pretty much put that genie back in the bottle, and they care about their reputation more than anything, I think. But the idea of like an Operation Twist, where the Fed sells short-term Treasury bills to buy longer-term bonds, that absolutely could be a very likely scenario, especially in light of some of the comments that Janet Yellen has talked about concerns of the liquidity of the Treasury market. So that's the main distinction. Again, to tie a knot on the difference between bonds and bond funds is just the ability as an individual bondholder to kind of manage the hold to maturity and manage that dynamic.
All right. I'm going to move on to a question here from Lieutenant Dan. So we've talked about a recession coming. When we enter the layoff phase of the recession, how will that affect the markets, stocks, bonds, and currencies? I think stocks and bonds are probably part of the markets there, but let's phrase the question as, hey, if we're correct and that we do fall into a clear recession next year, and that it's bad enough that we're having substantial layoffs, and let's call layoffs millions of people losing their jobs, what type of impact do you expect that to have on the markets? Mike, why don't we start with you?
I think without a doubt, it would be a very negative impact, on the stock market in particular. The question asked about the stock and bond market. I don't think necessarily the bond market would be down more. The bond market has had the worst 1 year return in a couple hundred years. And, John mentioned a chart. I'll bring it up just because he mentioned it, and it doesn't seem like he was able to bring it up. But hopefully you're looking at that chart. We've had just a ridiculously bad year in bonds. And so it's quite likely that if a recession becomes not only imminent, but recognize that there could very well be a rush into long, high quality U.S. bonds. And so, bonds could actually perform very well under such a scenario. The stock market, though, is still priced to perfection. As I mentioned before, we're barely at the top of the previous peak of the bubble in the year 2000. I'm going to stop sharing now. And so I would expect the stock market to actually decline quite a bit. It's hard to say exactly how far it would fall or how far it could fall, but we could fall 50% from here and still not reach undervalued territory. And so we're just at the start of, I think, a lot of different companies, particularly the previous darlings, the FANGs, so to speak, are reporting numbers that are less than stellar. And sure, there's some other names that are reporting great numbers, like old school Dow stocks and energy stocks and things like that. But the stock market should be a lot lower than it is today. We're presently at around 30, almost 3,900 on the S&P. I'd expect the S&P to be below 3,000, for instance, if it became very widely known and recognized that we're in a recession. Particularly if there's no clear path or understanding of how we get out of it. Now, of course, everyone is only going to talk about the Fed pivot even more if that's the case. As far as currency, I don't really have a good feel for that. The currency's been extremely strong. Absolutely, we've got a worldwide shortage of dollar-denominated collateral, so we could see further strength in the dollar. The whole dollar milkshake theory, Brent Johnson has been right on that so far. So, the dollar could actually hold up. But the real risk to the downside during that type of realization of the recession would be in stocks, in my opinion.
Yeah, and presumably they'd be laying off people because they can't afford them, meaning their margins have been compressed, which obviously is bad for stock prices. All right, I'm going to bring this question in from Civil Guard K9 LLC, who just paid for this question. I didn't even know you could do that in this platform, but since he paid to get his question bumped up here, I want to honor that. He's asking basically, name your top 3 global critical events that are your biggest black swan candidates that could disrupt the markets and or the banks. So Lance, you're never short of an opinion here. I'll toss one out there, which is, hey, things with Russia go real bad and nukes get involved tactically or somewhere else. That would be a pretty awful black swan event. What else would you add to the list?
Well, first of all, anything that we talk about is not going to be it, because the whole issue about what is a black swan event is something that nobody anticipates.
By definition, nobody was thinking of it. Yeah,
exactly. So, the whole issue is so, you can't answer this. This is an unanswerable question, because if we go, well, it's going to be China, it's going to be Russia, it's going to be treasury crisis, whatever it is. Market's already pricing all that in. Market's been pricing in Russia now, and everything's going on in Russia since February of this year, right? So China's getting priced into the market. It's been doing that for a long time now. A lot of the pressure that we saw, over the last month has been because of China lockdowns and those type of things. So all these events, the Fed, that's an event that's already priced in. So all these things are getting priced in. And one of the problems with, the outlook for next year, and you've got to keep this in mind, is that we're all sitting around going, hey, a recession's clearly, obviously coming. The market knows that already. Market's pricing that in. So a lot of the decline in the markets, and again, you got to be real careful when you look at markets too, because if you go, well, the S&P is only down 20% this year. There is a crap load of stocks that are down 70, 80% this year. There has already been a major bear market in a lot of the sub stocks below the top 10 of the index. So there's already been a lot of that, former froth taken out of the markets, because the markets are pricing in. They're saying, hey, everybody's talking about a recession coming. They're going to be doing, they're pricing that in already. So the one thing we've got to be really careful about as portfolio managers is not getting too bit into one particular view, because things can change. Again, the Fed can come out and do something. I saw a couple of questions roll by here on the other side. I was like, well, if the bond market freezes up, all the banks go out of business. No, that's not going to happen. And the reason is that the Fed is there. We have FDIC insurance. We've got all kinds of backstops for major banks now. And so what happened in the financial crisis, that won't happen again. We built in backstops for all that type of stuff. So again, we've got to be a little bit careful when you start trying to find reasons why the market's going to collapse and fall and go down to zero or whatever it is. You've got to realize that markets are pricing all this stuff in. Now, that doesn't mean that something can't happen that causes it. I'm not making that statement. But whatever it is something that you and I and everybody on this channel is not even thinking about yet. Nobody in February of 2020 thought we would shut down the economy because of a pandemic. Well, we did. But that was an unexpected black swan event. Lehman Brothers going bankrupt was an unexpected black swan event. Nobody ever thought you would force Lehman into bankruptcy, but we did. So whatever happens next year, it's not the housing market, it's not the treasury market, it's not the Fed, it's not a recession that's already getting priced in. It'll be something that we have no idea is even brewing out there. And it'll be something we wake up one morning and go, oh crap. And that's where we'll be in the middle of it.
All right, I'm going to ask John and Mike the same question, but given your caveats, given your caveats, what name one or two things that kind of keep you up at night, right? About like, all right, if this happened, that would really stir things up.
I guess I'll take a shot there, and this is just a wild, not wild, but a out there kind of scenario. Basically the Treasury having to come in and rescue the currency market. We're seeing the Japanese currency market be put in real distress. We saw some fireworks in the UK. I think we're dangerously close to that kind of scenario potentially happening here in the US. So as crazy as that might seem, the reserve currency, the bigger and better dirty shirt on the planet, I think it's not at all inconceivable. So that certainly keeps us up at night. And who knows what kind of draconian measures might come out of such a thing? Capital controls, markets being gated. Who knows? There's all kinds of scenarios there. But what I would like to
is that tied to Janet Yellen's warnings about the liquidity drying up in the Treasury market here, or is that a separate issue?
Yeah, I think it's related to that. Kind of the functioning of the U.S. government to be able to finance its operations. That's a concern, and again, that may be imminently not a likely event, but it's certainly not one we can take off the table. So you asked for black swan. That's a black swan. The one point I'd like to just make to close my thoughts on this is that we almost don't need to worry about a black swan to still preach and have good reason to suggest folks use prudence and caution in these markets. Even if things stay perfectly intact and rosy and corporate margins remain at near record levels, there's still plenty of data suggesting that the return potential from these current levels remains very muted, if not even negative, over the next decade from a historically informed perspective. So there's plenty of good reason to be cautious and muted in one's expectations about future returns across the board, irrespective of any kind of black swan event.
Good point, Mike. I'll let you put on your fear hat here for a moment, and since it's the day after Halloween, and then I want to get to the housing market, since I can't remember who mentioned it, but someone brought it up recently.
Well, Lance is right. Nothing that we say here is going to be the one. It's going to be really random. The obvious ones would be China attacks Taiwan. That would be one. Another one, Russia launches a tactical nuke into Ukraine. Those are the obvious ones, probably not what's going to happen. So I don't know. I'm not so sure that it's even worth much time to speculate and think about. To me, the black swan and the real, I think, disappointing thing would be is if the Fed continues to always and forevermore get away with just printing more money without any real consequence, because I think consequence has to come so we can have freer markets. And yes, that does imply some pain, but I think that would be the thing that would keep me up more at night than anything else, is that it's only about the Fed from now until eternity, and, I, for one, would like to see some more, fundamentals and some more normalcy come back into markets so that we can actually get down to talking about some real things, industries and innovations and companies and things like that.
All right. Well, hopefully, since you mentioned the Fed ever continuing to intervene, since you said none of the things we mentioned is going to happen, hopefully that doesn't happen going forward. Something tells me it may still a bit. Yeah, go ahead.
Well, no, look, the issue is that, again, and what the point was is that, these black swan events are very uncalculable, and trying to, and this is the important part about that, trying to invest in a manner expecting a black swan event. This is what we talked about before, is that more money's lost trying to anticipate a crash than the actual crash itself. So, don't worry about that type of stuff. Focus on what's important and stuff that we know now. And again, this is why, we're running, and this goes for every one of us here. We're all running high cash levels. We're all running underexposed to equity risk. We're all taking advantage of rallies when we can, selling into rallies. We're doing tax loss harvesting right now early this year, just for the same reasons, using this rally to reduce risk. Manage your portfolio for what is. If you're always, looking for the worst possible outcome, you're never going to invest. The most successful investors in history are optimistic. They're always looking for what is the positive outcome. Always bargaining yourself to the negative outcome will keep you on the wrong side of the trade long term. It's important to understand the risk, but don't get so biased into one kind of focus and always looking for the dark cloud on the horizon that you miss all the other great opportunities that are out there.
Right. Very true. And, very important reminder to focus on what we can control. Don't get yourself wrapped around the axle for these super long tail events that may never happen. And that's what diversification is for, right? That's why you have a diversified portfolio. If something that nobody expects happens, if you're diversified, you're going to be likely less impacted. And yeah, you might lose a lot of money if this is a big thing, but hopefully relatively not as much as everybody else. So on a relative basis, you actually come out okay. I love that we've got so much talk about aliens as black swans here. So nobody mentioned black alien swans coming down here, but who knows? Maybe that might be the thing. Okay, I want to get to housing real quick, but I do want to mention something or ask a question to you guys all real quick because it's come up a couple times here. You guys have said, hey, X is priced in, or the market is pricing X in. John Fieco asks, how do you know when something's priced in? John, let's start with you.
I don't think we necessarily agree with that statement that everything is priced in. In fact, we know that markets can be dangerously inefficient. That's kind of a statement of a modern portfolio theorist, that the market's always perfectly priced for all the known information.
Yeah,
so
let's take that part off the table. But if you think, the market has priced something in, is there a way you can actually quantitatively measure that, or is that more sort of a gut feel of like, the market's talking about it, therefore it must be pricing it in?
This is a misinterpretation of the statement. So first of all, I didn't say that the market has priced these things in. I said the market is pricing these things in. So, everything that we're talking about, recession, and again, we're going back to black swan events, right? Everybody is aware. Okay, let me just put it this way. If we have a recession next year, this will be the most forecasted recession ever in the history of the world, period, end of story. Markets never expect a recession to occur. In 2007, 2008, we're in the middle of a financial crisis, and and Ben Bernanke's going, yep, no recession here, we're all good. Nobody expected that recession to occur, even though we already knew we were in the middle of it. And so this year, everybody's going, no matter who it is, we're going to have a recession next year. The Fed saying we're going to have a recession next year. Treasury, recession next year. Politics, recession next year. Everybody's talking about it. So if everybody's talking about these things, the market is already starting to price that in. And again, to the question, there's no way to know if it's all priced in. We could theoretically, it is possible that we have a recession announcement in, say, January, just pick a month, and the market goes up. It's like, because the market goes, okay, good. We were all expecting recession. Now we have it. Now let's look forward. Markets are always going to bottom before the actual economy does. So again, you've got to be careful about this, because markets are always looking ahead and always trying to adjust for what they expect earnings are going to be, what revenues are going to be, what profits are going to be, and then go from there. And so you've got to be careful. Again, going back to this, is saying, this recession's coming, stocks have to fall 50%. It's possible, but it's also possible that stocks could go up. It's also possible that maybe they don't go down 50%. Maybe they only go down 10% more. We don't know where that bottom ultimately is. That's why we have to navigate the risk as it comes.
Yeah, Adam, if we could just add on to that, I totally agree with some of the points Lance just made there, and I think we can almost put it in terms of sentiment. Earlier on, someone referred to Powell's statement about markets and people are going to have to feel some pain. no one's felt, well, I don't want to say no one, the pain has been quite muted relative to the problem that needs to be. So markets tend to price in, I think, qualitatively speaking, at major extremes. So major bubble tops, the market's pricing in amazingly rosy conditions forever, right? That's what you can look backwards and see in bubble tops. The same can be said in bubble crash bottoms. In early 09, when the market bottomed and started rising on the housing bust, people were pricing in about as pessimistic a future as you could imagine, right? So at major extremes, I think, and it ties into sentiment being kind of extreme in either direction. Markets can not only fully price in, but overprice in some of those scenarios.
Okay, great context. And I think the spirit of the question was sort of like, oh, is there some place I can go to see how much of recession is currently priced into the S&P today? There is no exact metric on these things. It is a bit more qualitative. But I think to what both of you guys said, sort of the more it is being discussed, the more confidence you can have that the market is pricing it in to a certain extent. All right, so housing. Number of questions about housing. We've talked a lot about rates going up. There's so many questions here now. I'm having trouble finding one of the exact ones to be able to pull it up on the screen here. But Mike, let's come to you and just say, look, interest rates are continuing to rise. We have high confidence the Fed is going to continue to hike the Fed funds rate. Probably very soon, probably by 75 basis points, and then probably a few after that, or as long as you can get away with. Mathematically, it's got to put downward pressure continued on home prices here. We're seeing a softening of the housing market. What inning would you put us in terms of, if you agree that housing prices are beginning a correction, what inning would you peg us in that correction, and how bad do you think it's going to get?
Maybe the second inning, in my opinion, Adam. I mean, we just saw a huge increase in interest rates in a short period of time. The chart we showed you earlier showed a greater than 20-30% decline in the 12-month basis in long-term bonds. Mortgages are priced off of the 10-year Treasury note. The 10-year Treasury is around 4.1 or 4.2, and mortgages now are pretty solidly above 7% on the 30-year.
I don't have that here in California.
8. Wow. I don't have the exact numbers in front of me, but if you look at what amount of house a $1,000 mortgage payment will buy at 3% versus 8%, it's a huge difference. I mean, it's like a 40% difference. And so obviously that has some play in what the real estate market is doing. Now, there's a lot of cash out there. A lot of people got wealthy in this whole everything bubble. So I mean, there's a lot of cash buyers out there still that aren't relying on mortgages, but I think it's just a matter of time before you see that affect the real estate market more and more. Certainly seeing a turn in the mid to high end real estate market already. It's definitely turned. We're past the peak, and most of the 2021 blow off top bubble now has been repealed in those markets. On the lower end of the market, the starter homes are holding their prices really well, and I would expect that to continue because the whole market is squeezing down now into the bottom, and there's just not a lot of the lower end starter homes. So I don't think I'd be speculating in the real estate market right now, certainly with leverage, because I think it's very early. Again, I think it's in the second inning. And I think the real estate market will follow the stock market, and perhaps with a little bit of a lag. I expect the bear market that we're in to last longer. Obviously, can't guarantee or predict the future perfectly, but I think the stock market is early in its bear market. Maybe the third inning. I think maybe we'd see another 12 to 18 months of this bear market overall. Again, impossible to tell for sure. And then the real estate market should follow that and maybe lag behind a quarter or something like that. So I think the stock market could fall by more than 50% even from here. Doesn't have to, like Lance says, but it certainly could, and still not be undervalued given the extreme set of conditions that we've seen. And the housing market probably will fall by less, maybe 30% if I had to make a crazy guess. But still, it's very early in the game. And if you're looking to buy property, particularly if it's not your first primary home. This is maybe a second home or a speculation or a rental. I personally wouldn't be in any real rush to buy that. I think you're going to have your time and place that you can pick a better place to enter that market in the next year or two. That's my opinion.
Okay. I just want to toss the question out there. It says the folks that are watching, they're all regular individual investors. If you all are more or less in agreement that a correction of the scope that Mike thinks could happen, is there any particular advice you'd have for folks right now? Because for many people, home is a big part of their total net worth. For a lot of people, it's maybe the biggest part of their net worth. I guess the question is, if there's a material correction in home prices, how painful could that be in terms of watching a good chunk of their home valuation evaporate? Now, it might not matter if they plan to stay there for the next couple of decades, but also in that same environment, that's probably going to be a big depressor of consumer spending because people are feeling a lot poorer, and that's probably going to hit the stock market. That might even create layoffs. So how big a deal is what's happening in the housing market going to be for the coming year or so? Lance, we'll go to you, then we'll come to you, John.
So I think you've got to really kind of separate this out into a couple of things. One, look, you and I talked about, I sold my house early this year, peak market, prices were stupid. So we're now renting a house. So thanks to my backdrop.
Hey, sorry, quick question, but I'm just curious. Do you know if your house, could you have sold your house today for what you sold it for back then, if things already started cooling in your area?
No, they're already down 10 to 15%, and house sales are now sitting on the markets for up to almost 3 months now. So
okay.
Yeah, no, we got very lucky. We pretty much top ticked the market on the sell. But look, let's talk about some things. First of all, housing is very specific to the area you're in. So when you start talking about, I get questions all the time. It's like, I'm looking to buy a house. So, how much you think it'll fall in this area, right? So California is very different than Texas. Texas is very different than, Oklahoma, as an example. So depending on where you're trying to buy, some housing areas didn't run up as much. So the decline there may not be nearly as much to get back to a reasonably good value. California might be a very different story. So, real estate is always location in terms of price. Prices are definitely going to come down, as Mike said. Look, people buy payments; they don't buy houses, right? So it's all great to go buy a $300,000 house if I can afford it, but most people are having to use 3% down payments or some low level of entry mortgage payment. Having to split the mortgage in two pieces to try to get the deal done, whatever it is, because they really can't afford the house. If you can't put 20% down on a house, you really can't afford the house. I mean, that was why we used to have 20% down payments. It was an assurity that you had skin in the game, and B, if you can save up 20% for down payments, you also have the cash flow to make the payments over time. And so part of this housing bubble has been created by all of this maturation of loan structures and everything else that we can do to try to cram people into houses that they really can't afford in reality. So, that's the problem. So now one thing is the housing price is already coming down a lot more than what we know. So to Mike's point, he said, maybe we're in the second inning. It may be maybe third or fourth inning, actually, because by the time all those housing numbers catch up, it's about a 3-month lag before they show up in the data. So housing prices have already come down a lot more than what the data is showing. That's just a function of time until we play catch up. So we'll see that starting in early next year. But as we go through this, the important thing is two things. One, if you're looking to buy a house that you're going to live in, don't worry about trying to time the market. It doesn't matter. We're going to go through cycles over time. So if you're going to buy a house, you're going to live in it for 10, 15 years, it doesn't matter. Buy what you can afford, buy a house you want, whatever. When the opportunity presents itself, great, no problem. If you're trying to time the market to get the best deal, you're gonna have to wait another 12 months probably before we get there. My wife and I are actively looking, but we're looking 12 months out. So we've picked areas, we're scouting the neighborhoods, we're waiting for those transactions to come up. And to your point, Adam, we're watching houses right now stay on the market, and prices are getting cut by 10% almost every week. So those prices are coming down, and the area that we're looking to potentially buy our next house in, which will be a long-term hold, will It could come in January. It could come in March of next year. It could come before the bottom of the real estate market's actually in. So you just have to pay attention because, as you and I discussed before, real estate is all about what happens on the margins. People that are sitting in their house are going to live in their house for 20 or 30 years. They don't care what the price of the house is doing. They're living there. They're paying their mortgage. People that paid off their mortgage, they don't care what the price of the house is doing. They're going to live there for a very long time. So they're focused on other stuff. What happens at the fringe of the real estate market is people actively buying and selling. That's what makes the difference.
All right, got it. John, anything on housing before we move on to gold in the last couple of minutes here?
The only thing I'd like to add is just, and this is a big sea change that I certainly would hope for. The investmentation of housing has been, I think, one of the great blights. The idea of levering up your house as much as you can, and that prices are only going up, borrowing money to do any number of things against your house. I really, houses are places to be safe, to make hopefully great lasting memories with people you care about, and being very cautious with them. They should not be, never should have been speculative vehicles. So how does it translate? Don't think of a house as a form of retirement income. Don't think of a house as something to borrow against to go buy stocks like CNBC would have had you do many times over history. Just try to segment the house in your life as a place to find shelter from this world and the weather, and not as a place to think about ever rising prices and selling it someday. Now, of course, for folks in a house and have decisions to make, that's there's got to be a concrete decision process there. But speaking maybe to younger folks who are hoping to buy a house someday, and just to not think of it as an investment as much as a place to live.
One last thing on this, and John's right. If you really want to make a change to the housing market that would benefit the American economy, and I really struggle with what I'm about to say because it interferes with the freedom of capitalism, but you've got to figure out a way to get these major institutions like BlackRock and other out of the housing market, because they're buying up entire neighborhoods and converting those to rentals, and that's pricing people out of homes. There's just too much money there going after a limited asset. But again, I struggle with that comment because, again, what capitalism says is that we should have a free and fair market capitalism system, which should allow people to do what they, if they've got capital to invest, they can do these type of things. But I think there's a definite issue that needs to be addressed in some manner. And I don't think I have the right solution, but I think there's a proper solution to, providing a more level playing field with the average homeowner.
Yeah, I have strong feelings on that, in agreement with what you're saying. We don't have time to uncork that can of worms, but to John's hope, I'm right there with you, John. I do think it's going to be hard for that to happen if we don't somehow figure out how to curb what's going on the institutional side in the market.
Yeah.
Because there's just so much capital that those players bring in.
And that didn't exist, pre-2008, right? Pre-financial crisis, that type of capital intrusion didn't occur.
Which is bananas, because the latest figures I've seen are something like between 1 in 4 and 1 in 3 of all single family homes that sell are bought now by an investor.
That's right.
Right. So it went from nothing to, maybe a third of the market. And I've certainly seen some metros where it's been far north of that, maybe even far north of 50% at times.
Zero interest rates by the Fed will do that for you. Easy access to capital will do that for you. And then too much liquidity in the system. I mean, there's just so much liquidity sloshing around the system, not just domestically, but foreign inflows from China, Europe, Canada coming into the U.S. to buy real estate. There's just too much easy capital and too low of an interest rate. And again, higher interest rates actually provide a break for some of that.
Yeah. And, it's interesting. We talk about the dollar milkshake theory, but this is even part of the dollar milkshake theory, right? Where you've got these foreign buyers who just want to get their capital out of their own domestic nation. And they're fine if they end up losing 50%, because at least they got the other 50% of their capital out, right? So these very price insensitive buyers that are flooding over here. And of course, this is sort of won't call it a black swan, but it's a gray swan in the housing market, where we could have an issue where, let's say things economically get really bad. You can have some of these big institutional players who all of a sudden just decide, or maybe don't even have a chance to decide, they're just going under, and they just say, look, we've got to sell our inventory, right? And they can just potentially flood a market with inventory and crater prices in that market. But anyways, we're coming up here on the hour now, guys. Real quick, we had a bunch of questions about gold. I can't find a specific one, so I'm just going to put up Don Paris's one here. It's gold with a question mark, exclamation point. But a lot with gold is a question mark, like what's going on with gold right now. Mike, John, I know you guys track it very closely there in the New Harper portfolio. Mike, what do you have to say about your guys' thoughts on gold right now in the near term here, given what it's been doing or not doing? Oh, Mike, you're muted here.
Sorry there, Adam. I was just trying to share a chart and having trouble with it, but let me just speak to it. It's been a long haul for people that have been gold bulls throughout this whole bubble. Gold really hasn't performed well. Particularly in 2021, gold was down and everything else was up, and Bitcoin was all the rage. Now Bitcoin is 2/3 off of its high. But the chart I was trying to show you, and maybe I could still do it, I'm not sure, but I was trying to just show you a long-term 20-year chart of gold. It's got this giant cup and handle formation still. And it's been disappointing because the handle's gotten kind of messy, and we just had 7 straight months down in gold through yesterday's close. That hasn't happened ever, I don't think. Certainly not in the 20 or 30 years of the chart that I can see here. So it's 7 straight months down for gold. Pretty unusual. And we're sitting right here at around 1648. This 1680 area has been pretty critical for a while, and yes, I know we're trading below it, but I really think it's a fake out on the monthly chart. The long-term cup and handle still is intact, in my opinion, and I may just make one more effort to try to share the screen, and if it doesn't work, it doesn't work. But no,
Yep,
that's
I see
not
it come
working.
up. Yeah.
Can you see it?
No, I see you.
Okay, sorry. That's okay. If you look at a long-term chart, a monthly chart of gold, you can see that it had this high in 2011, had this long, 10-year consolidation period, and then broke out of that towards 2100 or so, and that happened earlier this year. It has since failed and has 7 straight down months. I still believe this cup and handle breaks to the upside, and a simple technical projection brings you to around 2500 on the gold price, and that's what it looks like to us. Gold is real money. It is outside of central bank control, but it's been a long haul for people that have been in gold. I think it's a great time to buy gold if you don't have it, and add to it if you don't have 5 to 10% of your investable assets in it.
Okay, and we should mention your comments there were largely looking at gold through the eyes of a U.S. holder. It's done a lot better in other currencies there. I think a big part of what's driving gold, obviously, is what the dollar has been doing. Maybe as we wrap up here, I'll ask you all in a moment just if you have any parting bits of advice. But for the dollar, which has just been a juggernaut this year, do you guys? I guess what do you think is more likely in the coming 2 quarters from here, dollar powering higher, or a pullback of sorts, even if it's just a breather before it continues climbing from there? Anybody have a strong opinion?
My best guess is that you're going to, the problem with the dollar is you're creating a lot of problems for foreign central banks and foreign economies. So my best guess is that probably sooner than later, part of this whole kind of dynamic with the Fed Treasury issue is going to be opening up dollar swap lines. We've already been doing it with the Swiss National Bank, probably doing it behind the scenes a bit with Japan as well. But eventually the strong dollar is impacting foreign economies very hard because, again, everything they import from us, they're paying more for. So it's just adding to their whole kind of inflationary backdrop. So, I would expect to see opening up probably Fed cash swap lines, or some type of issue to try to bring the strength of that dollar down and get world currencies more back in line with each other.
Okay, almost kind of dollar milkshake theory-esque, where the rest of the world is saying, look, US, you're killing us. You got to help us out here. And so we got to take that easing off. And that should be gold friendly, right, John?
Yeah, real rates. That's all you need to know about gold.
Yeah. All right. Well, look, so everybody watching, thanks for hanging with us for this hour. We got to start wrapping up here. First and foremost, if you continue to enjoy this format of the live Q&A and taking as many questions from you guys as we can, please let us know in the comment section here. We always want to try to meet your needs here and improve upon our delivery here if we can. Guys, in parting here, again, all the people watching here are just regular people who are trying to navigate, what we're currently going through and what likely lies ahead. I think people feel in general pretty nervous and just sort of overwhelmed by how complicated investing's become at this point in time and uncertain. What particular parting words of advice would you have for folks as they await next month's live Q&A with you guys? John, we'll start with you.
Well, I would advise folks to talk it out. Talk it out with your current advisor, a friend that maybe you trust. Certainly the team here at New Harbor and Lance's firm, I'm sure would be very welcome to have a conversation. The real stress happens when you don't talk about things and explore things and challenge one's own and even our beliefs. That's why we love these kind of formats. We get great questions. It forces us to always challenge our own beliefs and be able to articulate and crystallize scenarios. But bringing it to your life is really important. It's not enough to read the headlines and worry about the big picture economy. You got to bring it back to your own economy, your personal economy, and find out where your own level of contentment is. Contentment is a powerful thing. And that can oftentimes only be arrived at through looking at your own financial situation in an objective way.
Well put, John. And just a reminder for folks that are relatively new viewers of us, if you want to schedule a free, no commitment consultation with any of the gentlemen that are here on the screen right now, you can do that by just going to wealthion.com and filling out the short form there. All right, Lance, let's come to you next, and then we'll let you play clean up there, Mike.
So I think, I've been reading a lot of the comments in the comment section, and, there's a lot of kind of end of the world, doom and gloom, type scenarios, and that's fine. There's nothing wrong with that, but, try, and I agree with what, John just said, because, when you take a look at, the world as we see it, it's very easy to be very gloomy into the world, but a lot of that stuff is never going to happen. So it's important that, whatever you read, that's the end of the world, doom and gloom, in the bunker type stuff, go try to read something a little bit more optimistic and balance that equation. The biggest mistake that investors make and individuals make with their whole life, really, from terms of financial decisions of what they buy or what they spend money on, credit, all that, is based on confirmation bias. And that's the one thing that you want to try to avoid. Try to be a little bit more open in your perspective, leave some room there for something else to occur other than the worst possible outcome, because 99.9% of the time, historically, something else is going to occur that's not as bad as you think it is, whether it's in the financial markets or whether it's in life. We're terrified we're about to be fired, then we find out, no, we're not being fired. We just, got a pay cut or whatever. It's just, things are never as bad as we tend to think they are. But by thinking everything is going to end, and by being kind of locked into that view, again, as I said before, you miss out on making money, you miss out on opportunity, and man, that's just not a great way to live your life. You've got to be happy and enjoy your life, and kind of living in the bunker is not a great way to live.
Good perspective. Good perspective. All right. And Mike, we'll let you have the last word here, buddy.
Yeah, just like John said, talk about it. Talk about it with somebody you trust. Talk about concerns with your financial advisor. Communication makes it easier not to get frozen. You shouldn't worry too much, but you should also not be frozen. You should be in touch with the type of investor you are. You should be in touch with the allocation that you have or the type of risk that you're taking. This market that we're in is not offering a lot of mathematical expected return for risk, particularly in the equities market. So have a conversation with somebody that you trust and make some adjustments now, not later. There's not a rush to do it, but you don't want to do it later if we have a bear market that progresses and then you feel pressure to do it. So just get in touch with what kind of investor you are, and once you set it and maybe make adjustments, just leave it that way in the future. But definitely don't get frozen, and conversation helps.
All right. Well put. And just to put a coda on what all you guys said, which is the mission behind Wealthion is to help people, help enable people to fund their life goals. right? To make them more informed investors so that they can make smarter decisions to fund their life goals. And at the end of the day, what matters there in terms of your happiness in life is those life goals, right? So yeah, have these conversations, make sure that you are well positioned or well defended against what could happen and what you think is going to happen, but then spend your time focusing on those life goals. What do you want to do with your life, right? That's what it's all about at the end of the day. So great perspective from all three of you. Guys, thank you so much for joining me yet again for a little over an hour for this. We went over time yet again. I really appreciate you guys being flexible about that. Everybody else, thanks so much for spending this hour plus with us, and look forward to seeing you guys in a month when we do this again. Thanks so much, guys.
Thanks, everybody.
Thank you, everybody. Have a great day.